Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am talking to Mr. Jonathan DeYoe today. He's the best-selling author of Mindful Money, Simple Practices for Reaching Your Financial Goals and Increasing Your Happiness Dividend. So it seems like he's tying money to happiness and even reaching financial goals. So I am looking forward to this episode. As most of you know, that whenever I talk about wealth, building our wealth matters, I always talk about life and fitness. So for me, it's a triangle. If you're watching on YouTube, and they all go together, you got to have wealth. You got to make sure that you have physical health to enjoy that wealth. And of course, you got to have the mental health to pretty much, enjoy everything around you. And so that even people who hang out with you, they enjoy your company, right? So I am looking forward to this episode. Welcome, Jonathan.
Thanks, Alpesh. I'm happy to be here. I'm glad to figure out that we were neighbors, had a great conversation leading in. I'm looking forward to talking.
Same here. Tell us something interesting or funny about yourself.
Well, I guess interesting is probably the way to go, that more than funny. My family would tell you that I'm not a comedian. I'm not funny.
I tried to be.
16, my son would tell you I'm definitely not funny. But interesting, I can do. So I was actually a seminarian, meaning I was going to be a minister, and I switched from that path to a Buddhist academic, and I switched from that path to a financial advisor.
Whoa.
So there's that often throws people for a loop. That's probably the most interesting thing about my background.
From seminarian to Buddhist to financial. Okay, we got to talk about this after the podcast because I would love to know. So that's funny. So let's talk about investing first, because this is an investing show. What do you invest in and why?
Yeah, I've invested in everything. I have invested in real estate, private equity, hedge funds, individual equities, option strategies. I've invested in the known production oil wells. I've invested in wildcatting. I've invested in gems. I've made about 20 angel investments, small startup companies in the last 15
I've done
years.
those.
Today, my holdings are very, very simple. I have a 401k, looks like anyone else's 401k. I max that out. I own 3 broadly diversified pure equity, index-oriented funds, which I add to every single month. 1 domestic, 1 international, ex-US, and 1 emerging markets. And I have those same 15, 20, angel investments that I've been working on for a long time. And that is it. I literally sold my last piece of real estate probably 2 weeks ago.
Oh, really? Where was it?
Well, I had probably 4 or 5 properties in California that were sold a while ago. And then over the last number of years, I've gotten out of my real estate that was in South Dakota, which is where I'm from, Rapid City, South Dakota.
Oh, okay. Yeah, California, it's of course a good time to get out of it right now. As you and I know, in pretty high appreciating market as well as speculative market at this point. So it was a good time to get out.
I think we talk about this a little bit later, probably, but high market doesn't necessarily mean it goes down, right? It just maybe pauses for a bit or goes up more slowly, or so I got out because I don't like managing it. That's why I got out.
Right. Yeah. I'm on the other side. I don't invest at all in California because I don't like speculation. I like cash flow. It has to give me a cash flow every month. It has to be positive. I don't want to rely on after 5 years when I sell, it would have doubled or tripled. It doesn't matter. But yeah, that's everyone has their own risk tolerance as well as investment criteria. And if it works, well and good, right?
Yeah.
So let's talk about this. Put COVID-19, because, as you just mentioned, you also got it vaccinated. put COVID-19 into long-term context for families' finances, are you recommending any specific actions for people to take right now?
So it's a really interesting question because we are, long past the crisis period.
Yes.
And you've probably seen it. You've probably seen the recovery referred to as the K recovery.
Yes.
There's the L shape, there's a W. There's all kinds of different ways to look at it. This is definitely a K recovery. Most of the people I work with are either already retired or they're, white collar workers. They've been able to work from home. It's definitely been stressful, but from a financial perspective, the things that they could have done, they have already done. So March of 2020, we did a lot of we did a huge rebalance. So March of 2020 is the bottom. We sold a bunch of bonds. We bought a bunch of equities, which is sort of counterintuitive, but it's the right way to go. We did a lot of tax loss harvesting while we could. And that's pretty much what folks should do when something like a Great Recession or a pandemic, COVID-19 hits. And then more recently, probably the end of last year, beginning of this year, we've just been preaching refinance. I think I have the record for the lowest interest rate on a mortgage now. I just refinanced. I got a 1.875% fixed rate mortgage.
No way. No
yes,
way.
Man. Yes.
So after the podcast, you need to tell me how. That's great. That's free money. Yeah.
It is. That's
crazy.
Less than potential inflation. It's awesome.
Yeah, exactly. How can you go wrong? It's less than 2%, which is what historical inflation rate has been, right? That's great.
Yeah, but if you're on the other side of the K, I mean, it's about sort of rebuilding, and that's much harder. Finding work, relying on the federal benefits that are coming out, the state benefits that are coming out that are pretty generous, but you have to qualify, and some people don't qualify. And for those folks, I think the next 3 or 4 months, we're going to see millions of new jobs. We're going to see lots and lots and lots of new jobs come online. It's going to be the fastest recovery. It's not going to be like 2008. I mean, 2008 took 10 years to get to reasonable unemployment rate. This is going to be so fast. And we're seeing more and more evidence of that. And I'm looking forward to 4 or 5 months from now, looking back and seeing how fast the recovery unfolded.
Yeah, of course, in 2008, there were, banking industry, mortgage industry, insurance industry, they were all in trouble. And of course, we didn't print money as fast as we did this time. And this time, I think I was reading in a year, we printed more than in last 10 years, right? That's like crazy. That's called infinite money printing. And I think, yes, on the flip side, as you said, we'll see a lot of growth, but on the other side, we have to see inflation as well.
Well, we
could
see more taxes.
Yeah,
it doesn't have to lead to inflation. We will see more taxes.
Yeah, it's one way or other. They have to get the money back.
Yeah.
So let's talk about mindful money. Can you explain what mindful money is and why you wrote the book?
So let's start with why I wrote the book. I mean, so back in March of 2009, I sat with a client, and the client basically said, she was really nervous, and every year she would add a bunch of money to her retirement program once a year, make a big deposit. And she was questioning whether or not she wanted to make that deposit. And I was telling her in March of 2009 that, I have to admit, I don't know how this thing recovers. I don't know when it turns around. I don't know what it's going to look like 2 years from now. I just know, I have this sense, this feeling that money you put to work today, again, March of 2009, will be the best money you invest in the next decade. It's so low. There's so much, quote unquote, blood in the streets that that this is a great time to buy. I don't know how it resolves. I can't make any promises. I just think you'll regret it if you don't put it to work. And I told her the story in a way that she was like, you know what, you have to write this in a book. You've got to take this message and broaden it out for all those people who are so terrified right now that they don't know what to do. And so that's where the book came from. And then, she promised that she'd write the foreword of the book.
Oh, really? Nice.
And it's Alice, it's Alice Walker. So she's when a Pulitzer Prize winning author says you should write a book, you don't have a choice. You write a book.
No, yes.
So I wrote the book. I wrote the book for sure. And it's been pretty fantastic, the ride from the book till today. Lots of media attention, lots of conversations with new people. People have found the book and become clients. That wasn't the point. The point of the book was to give people an understanding of the false stories that we're told, B, an understanding of the stuff that actually leads to more well-being, more happiness, better living, and then C, a simple path to a financial plan. You don't need somebody like me. I mean, I'm good at it. I'm not saying I'm not good at it. I'm not saying I can't be beneficial. Not everyone has access to me or someone like me. So the third section of the book helps people write a financial plan for themselves.
That's great. And I did, of course, I haven't read the book, but I did look at the summary, and you did mention about something goal focused and planning driven. What do you mean by that?
So goal focused and planning driven, the best way to define it is to look at the contra. So our world, the problem with investing today in our society is we are way too market focused and performance driven. Now, it's a problem because neither the market nor future relative performance is predictable or manageable in any way. So there's a lot of research that tells us that the vast majority of people who try to do this fail. So those who do succeed, luckily, they're not skillful, they're lucky, right? So there's a better way.
Right.
we refer to that way as being goal focused and planning driven. Now, the first step is understanding values and making appropriate trade-offs. Those trade-offs you need to make in order that those milestones come true. It's kind of a fancy way of saying financial planning, right? And if we change from the market focus, performance-driven methodology to a goal focus and planning-driven attitude, we begin to actually pull on levers that work, that can provide better outcomes. So that's the goal, is to help people provide better outcomes.
And another question I had, because I always talk about money, of course. Wealth Matters is the show. Why is money such a significant source of stress, whether we have it or not, right? When we have it, of course, as you and I were chatting, right? Investing, where should I put my money in? And then I have shiny object syndrome. And of course, you have done the same, like you have invested everywhere. Like I have done private equities to cryptos to oil wells to real estate to conservation easements, ATM, all over, right? So that's one of the stress, right? How I make sure that my money continues to grow and is available. But when we don't have it, that's a whole different kind of stress. Right. So why money is such a significant source of stress?
So there's the obvious answer, and the obvious answer is, as a culture, we teach nothing about money.
That's the biggest problem. Yes,
we're all flying by the seat of our pants here, and you and I, we might read blogs on money, we might read books on money, we might pursue a personal education about money, but if you don't, you have no context. You've got no understanding about how money works. You don't know how to choose your 401k investments. You don't know how to insure, what to insure, how much to insure. You don't know how to buy real estate, negotiate loans. So there's no formal education about money, but that's the beginning of the problem. The second part of the problem is that we've financialized everything. Like the idea of success is almost always financial. If you ask people, what does success mean to you? It's an income level, it's an asset level. The younger generations are actually getting away from this a little bit, but the greatest generation, Gen X, people like me, if you ask them the question, it's, I need to get to this certain level of financial success. And that's really what the entire middle section of the book is about, is remembering what real success is. It's you, and you mentioned this, like your three-part, your mental health, your physical health, your relationships, generosity, gratitude, positive mental attitude. These are all things that are actually really important indicators of well-being and actual success. So we can't just lump it into finance. Finance is supportive of those things, but finance in and of itself is not success.
Yeah, no, that's a great explanation. Also, you had mentioned about plan appropriate investing. Can you explain? Why do you say that successful investing is more about emotional intelligence than it is about financial acumen?
Yeah, there's again, I always look at the academics. And so there's a lot of research that says that people who try to beat the markets fail more the longer they try. So another way to think about this, right? Another way to think about this is people can get lucky from time to time.
Yes.
But the longer you rely upon luck as a strategy, the less sustainable and repeatable it becomes. Like blackjack tables, you might win 10 in a row and you might bet it all on the 11th one, and the 11th hand, you get destroyed. That's how most people do investing. The reality is, if you put all investors on a bell curve, there are always going to be some that are really successful and some that are less successful. The goal is to kind of be in that middle. That's why I talk about broadly diversified equity holdings, right? So then when you fast forward over a number of years, you get a new distribution, right? So there's people on the right that do really, really well, people on the left that do really, really poorly. Fast forward 5 years, those people change sides. And so you actually want to be into the middle as much as you can. And plan appropriate is you looked at your plan, you figured out how much risk you should take, how much volatility you need to suffer in order to get those goals that you have laid out in front of you. That's, again, it's goal-focused, planning-driven. So plan appropriate investing is building a portfolio, which includes real estate, includes those things that we talked about, but building the portfolio that has the right kind of volatility that gets you to where you want to go. You don't need to take lots and lots of risk if you don't need to take lots and lots of risk. Like I've got a client I met with yesterday who, they're very, very, very successful attorneys. They probably have $10, $12 million in assets. They spend a couple $100,000 a year. They don't need to keep working, but so plan appropriate for them is a lot less risk.
Right.
They don't need to have huge returns. They need to have small returns, consistent returns. But somebody that has less money and has bigger goals, well, they need to take a little bit more risk to create that asset base. That's what plan appropriate means.
Got it. Yeah. If they have less money, yeah, of course. And they have the age on their side too. Right. They can't start, going aggressive after 50.
Well, I mean, that's a question. It's based on the kind of people they are. I mean, 50 is the new 20, right?
That's true. Yeah. Yeah, it depends how long you want to keep working. I don't want to work too long. Which I want to work, or I want to work on things which I enjoy. That I will continue to do, right, which I'm passionate about.
Yeah.
So, but yeah, everyone, as you said, and I'm pretty sure you deal with a lot of different types of people. Everyone has different goals, different, mindset, as well as, of course, their condition is different. Maybe from outside it looks, oh yeah, they have $1 million, but maybe they have debt of 900,000, right? So you never know. And someone who is only making 200K may have barely a debt of 10,000, and that's they all have different. They are all in different situations. So,
yep.
So yeah, and I'm pretty sure you work with a lot of Silicon Valley engineers because you are here as well. So how do you deal with engineers, right? And because I'm asking that because I'm an engineer and we are always thinking from engineering perspective. Also, we like to crunch numbers because almost all of them are good at maths, right? So how do you deal with engineers?
So it's a good question. I used to deal with a lot more engineers than I do now. I mean, back in the late 90s and the .com boom, I worked almost exclusively with engineers.
Oh, wow.
Folks at startup companies, software, hardware companies. And it was actually, my dad's an engineer. So I kind of speak the language a little bit. And I'm also, I'm a spreadsheeter myself. I love, math, and people can think mathematically. I love it. So today I actually deal with a lot more families, small business owners, professionals, attorneys, doctors, these kind of folks, largely because my office used to be in Silicon Valley. Now it's actually in Berkeley, California. So it's a different subset of people. But the way we invest is so supported by data that engineers have always loved. I can show them the data. Like I'm not predicting, I'm not prognosticating, I'm not guessing. I can show people data, and the data is something that's really appreciated usually by engineers. I'm not afraid of working with engineers at all. I love working with engineers. It's very logical. Oh, there's data. Oh, I like that. Right. That's the engineering mindset.
Oh, that's great. Also, let's talk about, because you work with a lot of families, as you mentioned. How do they envision transferring wealth between generations, right? Or what do we get most wrong about it, right? Can you talk about that?
So it's almost not PC to talk about this these days, right? The wealth isn't supposed to be held within a family forever and ever and ever. And the reality is most wealth isn't. If you build wealth, there's a saying, I'm sure you've heard it, shirt sleeves to shirt sleeves in 3 generations.
Yes, exactly. They last about 3 generations. Even in my language as well, in the Indian language as well, there is the similar saying that it doesn't last forever.
Right. And there's human behavior behind that, and the behavior is simple. Like, and I don't know what generation you are. I'm sort of first generation with money. My parents worked really, really hard.
Yeah, same thing.
I was raised poor, but now I've built something, and my kids are going to benefit from that. They see how hard I work.
Yes.
They're going to see how hard I work, and they're going to maybe take some of those qualities, but their college is going to be paid for. They're going to basically have what they need without having to work too hard for it. Yeah. And then their kids, they're going to have no exposure to it at all.
Right.
And so by that's the 3rd generation. They're going to spend the money. They're not. So, it's on us to actually build structures to keep them from spending it down. The thing that we do the poorest, I have to confess that I'm not an expert in this because this is psychology, right? We prepare ourselves. We learn how to build wealth. We prepare ourselves. We learn how to manage wealth. We're the quarterbacks. We don't train and prepare the receivers. Like, the kids are going to get the money. They don't really know how to manage the money. They don't understand the work ethic behind the money. And if they're not trained and then you die and they inherit, what do we expect is going to happen? Right. There has to be a structure in place, educate and train kids on how to manage money. And that's got to start when they're, young, in high school, early. Yeah. So hope you're doing that with your kids. I'm trying.
Yeah, I'm trying, that's why I'm listening with, like, I'm able to relate. So my older one is in middle school, and I'm only trying to explain her. She's like, I want to know about stocks. I've been, I bought a stock in front of her. Then I'm showing her cryptos because that's going to be the future for them. But again, trying to, involve them as well, like you said, because they get to see how hard work we have done, right? We have put in, right? And as you said, their kids they'll be born with silver spoon, right? They'll have everything at their disposal. They wouldn't know anything about how money works. So yeah.
So I say make them work. I mean, it's my
yes, and I'm doing that.
Yeah, that's awesome. Like when my dad, well, even a better story. When my son was 9 years old, one of my favorite pictures is my son doing his own laundry when he's 9.
Nice.
We don't do his laundry. Haven't done their laundry since they were before 10 years old. My son and daughter both had jobs when they were 12. They are 11 or 12. They started, opening and closing the local pool. So you have to sweep. You got to take out the garbage. You got to cover it up and uncover it.
That's pretty interesting.
So I make them work, I say.
Yeah. Yes. No, that's great. So my older one already works in my business.
That's great.
Right. So there are 2, I'm killing 2 birds in one stone. She's helping me out. And of course, I'm taking advantage of the tax side as well, right? As you know, I can pay my kids and they don't have any, if I can, and I'm not trying to give any tax advice here on the podcast, but up to 12 grand, they don't have to pay any tax, right? So I'm taking advantage of that as well.
and you're funding their Roth IRA and their 529, right? Yes. Okay.
Yes.
Just making
exactly.
sure.
Exactly. I started her Roth IRA as of last year. So first 6,000 went in.
Yep. That's right.
Exactly.
Any earned money they have goes right in the Roth IRA.
Exactly. Great minds think alike. And I learned pretty fast from people like you.
Yeah.
So let's talk about the investment side now as well. Because from me personally watching all this, and again, I only have history dating back for 20, 30 years. Stock market, real estate, cryptocurrencies, all of them are at all-time high. Where would you put your money right now?
So it's given what we've just talked about. So that's the question is part of, or that question is specifically is part of the market focused, performance driven environment that we're part of. So when we talk about goal focused and planning driven, we worry less about this reality of what the market is doing today. It's true. Some parts of the stock market are at all-time highs. Some aren't though. Some geographies in real estate are at all-time highs. There's been huge real estate booms. Some aren't though.
Some are not. Yep.
Right. I'm not entirely convinced that crypto is a great investment just yet. It's certainly a potential huge speculation, but I don't think that most people should be deeply engaged in the crypto world right now. I am sort of personally and professionally fully invested. Money I manage for other people and money I manage myself, it is 100% invested right now. And I don't know what happens in the next 3 months or 6 months. No one does. It's impossible to predict, but I'm fairly certain about what happens over the next 10 years and 15 years. So when we talk with families about wealth for them and for their families across generations, we think that 15 years is a small time frame.
Yes.
And there's enormous academic work on this. What works over long periods of time? So we do those things: plan appropriate asset allocation, diversification, broad diversification, and we rebalance. Like those are the core behaviors. But the challenge for people is that we live in this immediate moment where everyone is asking the question, what do I do right now? What do I do right now? Markets seem really high. What do I do right now? And the implication of the question is that, well, it's high, it must go down from here, right? But here's two truths about markets, two truths. One, markets spend the vast majority of their time at or near all-time highs. Like it's actually it happens on a regular basis, but it's actually rarer for them to drop a whole bunch and then come back. It's usually they're at or near all-time highs. And that's been true for hundreds of years. And you can't predict when they're going to fall. You can't predict. So the second thing is markets being at all-time highs is not predictive of what markets do next. There is no predictive element of that statement. It's a fear statement. It's like, oh my gosh, markets are all-time highs. What do we do? But that doesn't say anything about where they go next. It never has. And so I'm pretty much fully invested. I actually think that yes, markets might be ahead of themselves, or specifically large growth companies might be ahead of themselves right now. But value, small companies, real estate in Ohio, some real estate in Texas, there's places in Utah. There's definitely places where you find value in public markets, in real estate markets. Crypto, I'm not totally sold on as an investment for long term. Could be a fantastic speculation, could go to zero. I don't know. I have no way to tell.
Yeah,
so it's difficult to say.
Right. No, yeah. And of course, if you are not involved, you wouldn't know, right? So I have been a crypto investor for 5 years, and I understand the space because coming from IT. And of course, there are 6,000 coins right now. So, and out of those, I would say 50 or maybe 100 are good projects. The others could turn to zero. So you have to compare this space to .com of 90s, right?
Yes.
Well, exactly same way. But if you had picked Amazon and Apple and keep it for 20 years, your $10,000 investment would be over $1 million right now, right? So I was looking at it, it would be like 1.4-ish to 1.8, right? So same way, if you would have picked, just Bitcoin 5 years ago, your investment would be, so again, you got to, figure out what you want to do. But again, I believe in diversification, right? So it's not just crypto or real estate or stock market. You got to make sure you are diversified so that, something happens, at least you are not covering, right?
Yeah. I like so back in the day with those gold miners, right? The way that you built wealth. I mean, some people found gold and got rich. The way you built wealth, though, is to sell shovels, right? And I think that for the first time, starting, I think 2 days ago, that's possible for crypto, because now we have the largest public market for crypto is now public. Coinbase is public. That makes a lot. I'm not an investor in Coinbase at this point. I think about it, but it makes more sense to me than buying the coin itself. Buy the place where the coin is traded.
Right.
That makes sense. Like,
Yeah, and I did invest right away. Again, I'm not asking anyone to invest because I understand the space. I had a cryptocurrency mining company and I'm starting
Wow.
another one. Literally, we are starting another one in June. So I understand the space. I'm not asking anyone to follow me, but
Wow.
you're right. So whenever people ask me for recommendation on coins, I'm telling them, if you don't understand or if you know stock market, then go with Coinbase or any other crypto related stocks. That is not an investment advice, but there are so many other crypto related stocks like Mara, Riot. So you can always invest in those and get indirect exposure to cryptos.
Yep. Yep. Yep.
So, no, this
Just
is
in
great.
case crypto goes to zero.
Yeah. Anything is possible, and that anything is possible with any of the large companies too. We didn't know that BlackBerry or Kodak would turn to zero, or Palm OS. I thought that was the best operating system ever built on mobile. It's nowhere to be found, right? So anything
Gone.
could, yeah. No one knew about Lehman Brothers or AIG either, right? So investment is risky.
Yeah. Yeah. It always is.
So this was great. Let's take a quick break. And after the break, we will go through the same 5 questions I ask every guest.
You're listening to the Wealth Matters Podcast. The Wealth Matters Podcast. For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. And I was talking to Jonathan and still talking to Jonathan. And he shared a lot of golden nuggets about how money works, mindful money, as well as, how investing process should look like. So, Jonathan, thank you for that. Are you ready for fire round?
Yeah, let's do it.
Would you be changing any business or investment strategy after this pandemic is over?
I would never change the investment strategies, but business is certainly going to change. Things. I mean, my own business and other people's businesses. Our footprint is probably going to change. I already have. I've been talking to clients, and I think about half of them are going to want to be sort of permanently on Zoom, not coming to the office. So, if it remains 50%, then I don't need as much square footage for my office eventually.
That's true.
Right. So that change is going to happen. It's going to affect a lot of people. The real estate downtown office space is going to be different. Zoom is going to give us a national footprint, whereas before we were hyper local.
Yes.
But Zoom lets us work with clients all over the planet, all over the United States.
Yeah, not only national, outside too. If any US expats are working out of
That's
US,
right. That's right.
So
that's the big
huge.
change, I think.
That's huge. Favorite real estate or finance or any other investment related book?
This is awesome because it's not finance, and I think you probably get a sense from that, from what I've talked about, right?
Yes.
You asked earlier about the importance of emotional intelligence. Not sure I answered that directly, but great business people and great investors must develop their emotional quotient right alongside their intelligence quotient.
EQ. Yep.
So I'm gonna EQ over right next to IQ. So I would recommend that people read classic fiction like Tolstoy, Morrison, Stegner.
Oh, really? Okay.
Yeah, absolutely. And then biographies about great people, and then sign up for Bill Gates, annual reading list, because reading fiction can immerse you in decision making. It can boost empathy. It can increase humility. It can improve decisions broadly. In a nutshell, reading fiction improves self-awareness and helps us regulate our emotions under stress better. Now, this is far more important than the specific lessons that we learn in a business book. So if you want to be a better investor, you want to become a better person, this is the path to that, reading fiction.
That's awesome. And yeah, so I personally don't read fiction. I do read biographies, and I love Bill Gates' reading list. So every year I do check that out for sure. But okay, I need to put fictions in my reading list now.
Read some Tolstoy. Read some Tolstoy.
Oh, he's awesome for sure. Yeah, when I was growing up, I did read some of those, but of course, I haven't read any fiction for, I would say, 20 plus years now. Any tool or website you recommend?
Again, this is going to be a little far afield, but I'll go with it anyways. So every single day I log in to Insight Timer. So
yes,
Insight Timer is a place. It's the app I use for my daily meditation, and
I got it. I
You have it on
too.
there, right? So, going back to becoming a better person, 10 minutes a day, 10 minutes of meditation every single day. This is what the research tells us. 10 minutes a day increases the size of your frontal lobe, decreases literally the mass, decreases the size of your amygdala. Your amygdala is your fight or flight center. Your frontal lobe is your thoughtful center. The way you solve problems is with your frontal lobe. So meditating 10 minutes a day, after I think 8 weeks, you improve your ability to make decisions under stress. So I would say Insight Timer is one of the greatest tools you can use. All kinds of different teachers, all kinds of different people you can listen to. It doesn't have to be Buddhist, doesn't have to be Christian, whatever it is you want to do, it's there.
So I should have guessed this. Someone living in Berkeley who wanted to be a Buddhist, of course, he's got to meditate.
Of course. 25 years. Yeah.
Wow, that's great. Any advice for beginner investors?
Embrace ownership and everything that comes with that. But stay diversified. Focus on exposures to broad indices, focus on diversification, but really when you have money, buy more and hold. When you have more money, buy more of that and hold. And when you have a little bit more money, buy more and continue holding. It's not about a trading thing. It's not about timing the markets. It's about buying and holding. And I think, when you referenced earlier, the real estate, the cash flow real estate, not the speculative real estate, that's kind of the same flavor. It's you buy
exactly.
stuff. Goes up in value a little bit. That's not the point. It cash flows.
Yeah. And my tenant is covering my mortgage, right? So I got to keep it for 30 years, then it's free, or 20 years, whatever, right?
Right.
How do you give back?
I've supported, I'm very active in my community. I'm a Berkeleyan, Berkeley, California. We're pretty, active in our communities generally. So we've supported a lot of nonprofits in the local community for 20 something years, health and human services, the arts, food banks, homeless shelters, and the like. Starting in 2020 though, we decided to do something more specific to what we do. And so we built financial literacy courses, and I have an 18 module course that's available to, free for our clients, free for their families. It's available to anybody for a small fee, but we're also actually looking to partner with schools, religious groups, entrepreneurial groups, anywhere where young adults come together. And we're willing to partner with them and give them access to free financial education for their membership, specifically, and actually you're in the Bay Area as well. So specifically within the 7-county Bay Area, we want to do that because I think that we all are better off if we are all educated about finance.
Got it. No, that's awesome. Thank you so much. How can my listeners reach out to you?
Mindful.money is the best place to go. You'll find your favorite social media on that site. You can sign up for our weekly market commentary. You can sign up and we'll send you an access to the course itself. And if you're open to it, in the show notes, which I assume exist at some point, we'll send you a link to a free course that's values, purpose, and goals. How you set goals based on your own values.
That's awesome. Yes, we will definitely put that in the show notes. Thank you so much, Jonathan.
You're welcome.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing.